Imagine you wake up one morning, switch on your phone, and you see it. The headline flashes, AI stocks hit record high, gold breaks $4,000 an ounce. That's the scene now in November 2025. The world is cheering tech, betting on artificial intelligence, yet corrosion is quietly creeping beneath the surface. What if this rally isn't the start of something sustainable, but the calm before a storm? Let's step into the story. Over the past months, the tech-heavy indices have surged, largely driven by AI-focused companies. One reason: generative AI hype, chip booms, data centers, grand visions. At the same time, gold, typically a safe haven, has also exploded upward, climbing past $4,000 per ounce and posting its best year since the 1970s. That's unusual. Here we have a classic risk-on asset, AI stocks, and a risk-off asset, gold, both skyrocketing. It's like two ships heading in opposite directions, yet tied together on the same sea. The question becomes, why? And what happens when the tether breaks? In this video, I'll show you how three powerful forces are colliding right now: AI-driven stock euphoria, gold's record highs, and macroeconomic fractures, and why together they could spark a dramatic market reckoning. You'll learn 1. What's fueling the current frenzy, 2. The fault lines hidden beneath, and 3. The plausible scenarios that could lead to a sharp market correction. If you're invested or just watching from the sidelines, this matters. So let's begin. First, the frenzy. The AI boom has lifted valuations to unprecedented levels. Analysts are warning about stretched multiples. The Bank of England's Financial Policy Committee recently raised red flags about potential AI bubble risk. Meanwhile, investors are piling into gold, not just as a hedge, but in near speculative fashion. One report noted gold is trading like a meme stock, with mining shares up over 125% in 2025. What's going on? For AI stocks, mass narratives, media hype, FOMO. For gold, inflation worries, rate cut hopes, central bank buying, and the sense of where else can I go when everything else looks expensive. Gold's rally is supported by expectations that the Federal Reserve may cut interest rates and that the U.S. government's fiscal position is weak. When you get two extremes like this together, speculative tech and speculative safe havens, you're looking at a classical sign of confusion in markets. When fear and greed move in parallel, that's when the cracks begin to show. And that leads us into part 2, the hidden fault lines. One major red flag: high concentration in the market. A few mega-cap AI companies dominate indices, meaning any stumble in them could ripple through the entire market. For instance, analysts at the International Monetary Fund warned that the U.S. stock market is exposed to a meaningful correction because of this concentration. Another, valuations divorced from earnings. The excitement around AI assumes dramatic future profits, but a recent MIT-linked study observed that 95% of organizations are getting zero return from their investments in generative AI. In the gold market, while the narrative is of safety, the sheer speed and speculative character of the rally suggest we may be past hedge and into momentum. Trade reports show the recent gold surge is only the third strongest in past 50 years. But history tells us that after such surges, long sideways or downward phases often follow. On the macro side, global public debt is high, interest rates remain elevated, though hopes of cuts exist. Inflation still lingers and economic growth is uneven. The U.S. government shutdown delays data and economic clarity, adding to investor uncertainty. So you have lofty valuations, speculative momentum, macro uncertainty, and high debt. That's not a recipe for a smooth ride. It's a recipe for risk. Now imagine this scenario. A key AI company misses earnings. Suddenly, investors question not just that firm, but the AI supercycle narrative. Stocks wobble. Given their dominance, the broader index falls. Panic filters through. Simultaneously, gold, which has been running almost as a speculative trade, reacts. Instead of rising further, it stalls or corrects because now the safety narrative clashes with the momentum narrative. The two assets that were bizarrely rising together now both wobble. That would strip confidence across asset classes. And when confidence goes, liquidity tightens, credit spreads widen, growth expectations drop. That's when markets crash. Let's dive deeper and examine the hidden triggers that could flip the current market euphoria into a sharp reversal, and then explore how deep it could go. First, what are the key triggers? First, a shift in the narrative of AI. The current stock agenda is heavily tilted toward companies riding the AI wave, but experts are sounding alarms. For instance, the International Monetary Fund and Bank of England both warn that the AI-driven surge may be overheating and vulnerable to rapid sentiment change. Imagine this. One large AI company reports lower than expected earnings. The narrative cracks. Suddenly, transformative growth becomes, let's wait and see. That reversal could ripple through the index because so much of the market rally is concentrated, and when the dominant winners wobble, the whole structure creaks. Second, macro policy and interest rate surprise. The rally in both stocks, especially AI and gold, reflects expectations of low interest rates, cheap capital, and broad growth. But if the Federal Reserve, Fed, or other major central banks shift stance, raise rates, delay cuts, tighten liquidity, the cost of holding equities and bonds climbs for gold. If the dollar strengthens or rates rise, its relative appeal drops. We're already seeing signs. Gold's recent rally paused as the dollar ticked higher and profit-taking set in. In short, a rate shock or hawkish pivot could trigger a simultaneous drop in both risk assets, stocks, and safe havens, gold, a double hit. Third, credit and funding stress. While earnings and valuations get the headlines, there's a quieter but potentially outsized risk: funding markets. One recent analysis flagged that problems in US dollar funding, repo markets, or cross-border bank funding could transmit stress globally. 4. Valuations and concentration risk. Look at valuation metrics. The widely watched CAPE or Shiller P/E ratio for U.S. stocks recently moved into territory previously seen just before the dot-com crash. Similarly, a handful of mega-cap tech and AI names are making up a large share of market gains. A correction in one could cascade. In effect, there are fewer places to hide. 5. Gold's paradoxical rally as a canary. Why mention gold here? Because gold is rising alongside risk assets, a red flag. Historically, gold's safe haven role kicks when risk is high but stocks are falling. Here we see gold and stocks both climbing. That tells us investors are unsure. Part of them are chasing growth, part are hedging risk. That split mindset doesn't last indefinitely. Moreover, gold's rally has already shown signs of strain. A recent sharp drop, profit-taking, and risk from a stronger dollar or fewer central bank purchases. If gold's momentum stalls while stocks crack, only one direction is easy to imagine: down now. How bad could it get? What might the magnitude and pace of underlying correction look like? Let's build a plausible scenario. Picture this chain. An AI leader misses on profit. Investor enthusiasm takes a hit. Valuation rewinds. Tech shares begin a cascade. Simultaneously, the Fed signals slower easing, perhaps hints at maintaining elevated rates longer than expected. Funding stress emerges in dollar markets, and one funding crisis sparks broader concern. In that climate, gold attempts to act as a hedge, but because it has been surging for speculative reasons rather than purely safe haven reasons, it hesitates or declines. The combination: growth assets fall, hedges don't work, confidence wanes, credit spreads widen, liquidity dries, market cap illusions deflate. Historically speaking, when equity valuations have topped out as they have now, corrections of 20 to 40% are not uncommon. The average bear market in U.S. stocks has cut around 30 to 35% from peak to trough, lasting many months. While 2025 doesn't copy earlier crises exactly, the drivers today are eerily similar: euphoria, leverage, low real yields, and concentration. For gold, if the safe haven narrative falters or monetary policy surprises hawkishly, a pullback of 10 to 20% is plausible. Indeed, gold just delivered one of its largest one-day drops in over a decade. When stocks fall and gold doesn't work as expected, the shock becomes system-wide. Let's turn to what to watch. The signals that will tell us whether the correction is likely, how early, and how severe. Watch this list. Earnings from dominant AI companies. If growth or margins disappoint, that could be the spark. Fed policy statements and minutes. If rate cuts soon language disappears or hawkish tone returns. Dollar strength/bond yields. A rising dollar or rising real yields reduces the appeal of both gold and risk assets. Funding markets, repo rates, dollar swap spreads, non-US banks' dollar liabilities. Early stress, here is a systemic signal. Central bank gold purchases. If central banks pause or reduce buying, that undercuts gold's structural support. Valuation divergence. When stocks show weak breadth, few leaders holding the market up, and momentum falters, we're entering top territory. In summary for Part 2, we've moved from the broad story, Part 1, into how the collision of AI euphoria, gold surge, and macro credit stress could play out. The fault lines are clear: narrative risks, policy flips, liquidity fragility, crowded trades. If one domino falls, the rest may follow faster than many expect. When you combine everything is expensive, everything is going up, and no one seems afraid, you are statistically entering a high-risk zone. The question isn't if something might break, but which part breaks first and how fast contagion spreads. Now we reach the final piece: what could happen next, and what it means for investors, markets, and everyday people. Let's break it down into scenarios, from mild to severe, and then extract practical insights. Scenario 1: mild correction. Imagine the AI hype cools a little. One or two high-profile companies miss earnings or growth forecasts. Stocks wobble but don't collapse. Gold takes a modest pause or slight decline as risk recalibrates. Investors breathe, markets stabilize, and the media spins it as a healthy reset. Corrections of 5 to 15% happen all the time, and savvy investors may use them as entry points. The economy keeps chugging along, and confidence returns after a few weeks. Even here, there's a lesson. The market is telling you something is fragile. Momentum alone isn't sustainable. Diversification matters. Don't assume that growth will continue just because headlines are positive. Scenario 2: moderate correction. Now imagine a chain reaction. A major AI company misses earnings, other tech leaders falter, and suddenly indices lose 20 to 30% of their value over a few weeks. Gold tries to provide a cushion, but stalls because speculative buying has already exhausted upside. Market sentiment turns from euphoric to fearful. Margin calls begin in leveraged portfolios. Credit spreads widen. Economic growth data disappoints. This scenario mirrors past tech corrections, but with one twist: gold's speculative surge now fails to provide the full safety net. This is where portfolio construction is truly tested. If your investments are concentrated in a few AI or tech names, losses can be severe. Bonds and other traditional hedges may offer some relief, but the speed of decline can outpace reaction. Cash or liquidity becomes a strategic advantage. Scenario 3: severe crash. In the worst-case scenario, everything collides. AI valuations collapse, the broader stock market falls 30 to 40%, gold stalls or declines sharply, and liquidity dries up. Funding stress in banking and repo markets triggers panic. Investor confidence evaporates. We've seen similar dynamics in 2008 and during the dot-com bust, except now AI and gold are both central to the narrative. The shock could reverberate globally, affecting currencies, commodities, and cross-border investment flows. In this scenario, timing and risk management are critical. Being over-leveraged or concentrated in a few high-beta assets is extremely dangerous. The smartest investors often survive such crises not by chasing gains, but by preserving capital, hedging risk, and being ready to deploy liquidity when prices offer real value. Key takeaways for investors. Today 1. Diversify. Don't rely on one sector, one asset class, or one theme. AI is hot, but its concentrated gold is rallying, but momentum isn't infinite. Spread your exposure. 2. Monitor narratives, not just numbers. Markets often move faster than fundamentals. Watch sentiment shifts, headlines, and key earnings reports. 3. Liquidity is king. Having cash on hand allows you to act during sudden corrections rather than being forced to sell at a loss. 4th. Macro matters. Fed policy, interest rates, and funding markets influence everything from AI stocks to gold. Ignore them at your peril. 5. Risk management first. Position sizing, stop losses, hedges. These tools matter more than chasing returns during euphoric periods. As we close, remember this: market euphoria and fear are always dancing together. Right now, AI stocks and gold are moving in tandem, an unusual pairing that signals tension beneath the surface. Whether the market experiences a mild reset or a severe crash, the core lesson is timeless. Prepare for volatility, respect the risks, and don't get swept up in the hype. So, what's your next move? Are you positioned wisely for today's fragile market? Do you have cash, diversification, and hedges ready? Or are you riding the wave of momentum without thinking about what comes next? If this video helped you understand the hidden forces shaping markets in AI and tech, make sure to like, comment your thoughts, and subscribe for more deep dives into financial trends and investment insights. And don't stop here. Check out our other videos analyzing current market cycles, AI, investment risks, and gold trends. The market moves fast. Being informed is your first line of defense. Stay sharp.